Hey, MCE crew, I hope your day is progressing profitably. Listen up. We got $100 billion in additional stimulus that just started hitting accounts today. You might be among the recipients of that. We're going to talk about that in a minute. But first, let's talk about it in the context of how it is going to increase inflation. All right, so basically this $100 million has been allocated for, but it's just rolling out in the form of the child tax credit. So people are going to be getting up to $300 a month for each child whose age is up to 5 years old. Okay, so you've got a 5-year-old or younger, got a couple of them running around your house, then you're going to get $300 for each of those children based on certain income limits. Okay, so you're going to have to get with your tax planner, your tax provider. You can check out the links I'm going to have in the description to find out if you are eligible. Now, if you've got kids from 6 to 17, you're going to be getting $250 a month potentially for them. Again, there are some eligibility requirements based on your income and some other factors. But a lot of people are going to be getting this money, okay? So we're going to see $15 billion allocated on the street in July alone, all right? So July, we're going to have all that money rolling out, hitting bank accounts. And look, most people, they're going to spend this money. And the reason they're going to do that is because, as we've talked about, we've seen inflation tick up year over year. We're up 5.1%. We're over 5%. It costs more to feed a child. It costs more to clothe and house a child. So you can best believe that this money is going to be taken out of these accounts once the federal government puts it in. The first ones are rolling out on Thursday, depending on, I'll release this video either on a Thursday or Friday of July, I think 16th. Anyway, people are going to go to the grocery store, spend this money. People are going to go to the store and spend money on back to school items because the kids are going to be going back to school in roughly a month. And people are going to allocate this toward their rents, their mortgages. Okay, remember, with the rental moratoriums in a lot of these states, you still have to pay the back rent. Now, there are some programs designed to help you with that, depending on the state that you're in. But don't rely on these programs for expeditious resolution to that requirement, because the states, California in particular, they're dragging their feet. So we got $100 billion about to hit the street here over the course of the next 6 months. We're going to see allocations of roughly $15 billion per month rolled out, across the country. Okay, and let's get to a story here. The Fed officials see earlier in for bond buying emphasize patience. Now, the Fed is doing something a little disturbing here. They are actively speaking about their reluctance to negatively affect the stock market. Now, that's not in the Fed's job as the authority over monetary policy, okay? But they're out there and they're saying, hey, this is what we're trying to do. So let's look at some news here from the Wall Street Journal. Let's just go over a couple of things and talk about what's going on with the Fed. Now they've reversed course and, inflation is now a problem. Federal Reserve officials suggested that they might need to pull back their support for the economy sooner than they anticipated because of stronger than expected growth this year. We had about 25% of the Fed governors. Now, the Fed governors are in the various states. The Federal Reserve Bank governors are in the various states. About 25% of them said that they expect to see a rate hike sooner than 2023. Remember, Jerome Powell, Fed chair, came out and said that he expects to raise the rate twice in 2023. Well, the Fed governors, 25% of them at least, are more concerned that we're going to have to do that sooner. Now, if that happens, look, the media is going to blow it out of proportion. If they raise rates, they're not going to go in and raise the discount rate by 10%. Okay, whatever they raise it to, you can be guaranteed that it's still going to be at historic lows. But it is going to be above where we are today. They need to do that because that's how you control an overheated economy. When money becomes more expensive, so that interest rate ticks up, it becomes more expensive to get a home loan, a car loan, credit, okay, revolving credit, your credit card interest rate ticks up. Then people take a step back and they taper their purchases, okay? And that has the effect of cooling down the economy. It has a restorative effect on the supply chain because now you don't have as many people after lumber, rare earth elements, microchips, grapefruits, so on and so forth, okay? You understand it. Now, let me stop right here and just say the Federal Reserve Bank, it's a quasi-independent organization. It is not a part of the federal government. It has no reserves, and it's not a bank. So this is one of those mechanisms that is designed to confuse, okay, the average citizen. The average citizen thinks the Federal Reserve Bank is America's bank. Well, the Federal Reserve Bank controls monetary policy, interest rates, the supply of currency that's out in circulation, while the president and the Congress, the lower house, controls the fiscal policy, which is the ability to tax. The Senate's in there too because they need to sign off on those bills and get them passed in both houses before they go to the president. Fed officials discussing the matter at their June 15th through 16th policy meeting were not ready to reduce their $120 billion in monthly purchases of Treasury and mortgage securities, according to minutes of the gathering released Wednesday. But an unspecified number thought that the time could be approaching. So think about that. The Fed is out there putting $120 billion into the economy by purchasing treasuries. When they purchase the treasury, of course, they have to put money on the street in exchange for that. So you got $120 billion coming from the Fed. You got another $15 billion that's coming from this tax credit, which is talking about right now. This tax credit that we talked about. So you've got over $130 billion hitting the street still, okay, with the tax credit, part of the stimulus program, and the Fed purchasing of treasuries. It's a lot of money, okay? You're putting all that money out on the street, and it's going to be spent. Various participants mentioned that they expected the conditions for beginning to reduce the pace of asset purchases to be met somewhere earlier than they'd anticipated at previous meetings in light of economic data. So we talked about that. At last month's Fed meeting, 13 of 18 officials projected they would raise interest rates from near zero by 2023, with most expecting to raise their benchmark rate by 0.5 percentage points. 7 expected to raise rates next year. So that's actually, I said 25% before, that's almost 50%. In March of the 18, in March, most officials expected to hold rates steady through 2023. So you see, the sentiment has changed. Last year, the Fed laid out 3 tests that would need to be met before raising rates from their current setting of near zero. First, inflation would need to reach 2%. Check. We have surpassed that. Second, inflation would need to be expected to run moderately above 2%. I think it's safe to say that we've met that benchmark as well. And third, the economy would need to return to maximum employment, which officials haven't precisely defined. And let me tell you why they have not precisely defined that. Because we are replacing jobs. We are not creating new jobs. And then a lot of jobs are not returning due to automation and changes of processes. Hilton Hotels, for example, has said that they're going to need far less custodial staff. And the reason for that is because they're going to by request room cleaning. Okay, so if you want your room cleaned daily, don't expect the person to come around automatically. That's something you're going to have to request. Another hotel chain is doing that. So it's Hilton and another big hotel chain. It's not Marriott. The name escapes me at the moment. But you see these changes occurring. Now, you also have the kiosk and the fast food restaurants. You have Raytheon, who laid off contractors, thousands of contractors, due to the fact that the airline business slowed down. Raytheon is an aviation contractor and a defense contractor. So those are white-collar jobs. So we see a lot of jobs that are not returning. These companies have figured out how to deal with their situation via automation, changing process, and not needing as much work. So paradigms have shifted. This is in line with something that we talked about before, and we're going to go over in depth really soon here, and that's the projection that 80 million jobs globally will be lost due to automation by 2030. We're starting to see that. The events of 2020 have accelerated that pace, okay? So that's what's going on out here today, okay? We are looking at interest rates rising. We are looking at least 2 interest rate hikes in the next 24 months, somewhere within that time frame. We got $100 billion hitting the street by December in the form of the child tax credit. We got folks who are coming off of unemployment because a lot of states have stopped the unemployment in order to try to energize getting people back to work. However, that's a policy that may be like one of those where the teacher, one person was talking in the class and the teacher said, oh, so everybody has to be punished for that. So we got some people that are not going to be returning. If you lost your job at Raytheon as an engineering contractor and you were making 70 grand, okay, are those jobs that will replace that salary, are they out there in your field? Okay, we're gonna be dealing with this employment situation for a long time, for the future, in perpetuity, because our economy is changing. And I will leave it with this, as I always say, think about starting your own business. Okay, it is not a 100% panacea. It is not guaranteed that you're going to become the next Jeff Bezos, but one thing about your own business, you do have the unlimited earning potential, okay, if you manage it correctly. As I always say, the Small Business Administration is clear about a properly managed business in the right industry, being able to potentially return between 15 and 30%. You're not going to find those returns anywhere else, unless you are one of these hedge fund managers. Maybe. Okay, guys? So that is it for the day. I will talk to you soon.